Hello everyone and welcome to yet another exciting interview by Financial Insight. Yes, today again we're sitting down with our friends from Finwise Analytica where I'll be talking to my good friend Chiti, who's the CEO there, to tell me about the second edition of their MFI report. So stay tuned and don't go away right here on the Financial Insight Show. Welcome back. And Chiti, welcome back to the show.
Thanks, Mwelwa. It's a pleasure to be here.
It's always a pleasure, and I'm super excited. I got the call from you literally like a few days after we did our last interview that the second edition of the MFI report was ready. How does that make you feel now that you've churned out the second one?
Exactly. So I think for us, like we've always said, the consistencies will always be there. And what is even more important is that you'll be seeing even more metrics, more information, even non-quantitative information. You start to see that in the subsequent reports. And the response has also been very overwhelming.
Absolutely, absolutely. By the way, I mean, I must share with you, I was at the supermarket and I actually met, a gentleman who actually owns an MFI, and he was, bothering me, saying, when is the next report coming? I said, look, I've got Chiti on speed dial. Exactly. We will be having this interview soon, but not to worry. But before we get into that, obviously, we always like to just catch up with you. We're just a couple of days, if I may say, before the 2026 budget is actually announced. Are you able to just give your sentiment around how important things like taxation around MFIs, how MFIs actually look at things like that, and will they be paying attention to Dr. Msokotwane's budget speech?
Precisely. So I think not only MFIs, but I think the entire financial sector. But if you look at MFIs specifically, you've got about 6 deposit-taking MFIs, you've got 26 non-deposit-taking MFIs, and the rules, for example, around provisions are a bit different from the other MFIs that are not regulated, for example, by the Bank of Zambia. So for them, those are some of the things that are really key. How does that, for example, interact with the tax, and will there be any other incentives that will come through from the speech? So it's things like that. Also the interaction that we're seeing between the financial system and the telcos. Will there be anything that will change? Because if anything changes on the other side, it will probably trickle back into the MFI space in terms of how do they price their products. So there's a whole lot, not just specific to the MFIs, but across other different aspects that might affect MFIs indirectly.
Right. Now, Chiti, this is your second report. Are you able to just give us some overview if there's been any changes in the sort of things that people can expect to actually see, and also just a quick take in terms of how they can access the report?
Perfect. So before we even go into the specific MFI report, what we've done in this edition is we've looked at the entire space, the entire system where MFIs operate. And we go and say, okay, fine, can we look at the financial sector? So we're talking of commercial banks, we're talking of MFIs, we're talking of other non-bank financial institutions. So we just want to put MFIs in context of this whole system and say, how are MFIs playing in the space? And also, are there any trends that might interest MFIs? So, for example, what we've noted is, if you look at the loan disbursements, you go back in 2020, and these are loan disbursements done by the entire sector, so banks, MFIs, and non-bank financial institutions, of course regulated by the Bank of Zambia. So you notice that for every 100 kwacha that was disbursed, 27 kwacha went to government. So what that meant is that you only had about 73 kwacha that remained for you and I, households and individuals, businesses, agri, and any other sector. Again in 2020, you had out of that 100 kwacha, every 100 kwacha that was being dispersed out, you had 43 kwacha going to businesses. Households and individuals only accounted for 20 kwacha. So households and individuals, this would be your consumer lending predominantly, right? If you go to 2024, out of that same 100 kwacha, the portion that is being dispersed to government is only 3 kwacha. So it's moved from 27 kwacha to 3 kwacha. So in simple terms, it's 3%. So it moved from 27% to 3%. What that means is that for that 100 kwacha that was being dispersed out, there's now a 24 kwacha, which is available for you and I, or for the next business out there. So the next question then is, who has taken up this 24 kwacha?
Correct. I'm very, very curious.
So if you go back to business was 43%.
Yes.
And that was 2020. If you come to 2024, business is still 43%. And remember, we said government has moved from 27 to 3.
Correct.
But if you look at households and individuals has moved from 20 kwacha to 43 kwacha. So for every 100 kwacha that was given out on average, 43 kwacha of that went to households and individuals, consumer lending. So meaning it's now at par with the amount that went out to business. And when we look at the surveys that we've done, the next question then is, what is driving that?
Correct.
And those are the things that we'll now look at in terms of what's driving the demand.
Correct.
Is it paying school fees, or are they using this money for productive purposes? But we also find that there are things like credit stacking. I get a loan to pay the other financier, then I only get the difference between those two. So there are all those complexities, but that's something that we're seeing in this space. And then when we go down now to the specific MFIs, and in this case we're looking at the deposit-taking MFIs, we've seen a 21% growth in terms of deposits to about 2.6 billion. In terms of gross loans and advances, they've gone up by about 5% year on year to about 6.7 billion. But remember, even last time we mentioned that we are seeing a shift in terms of the market share between deposit-taking institutions and non-deposit-taking institutions. So for the first time in 2024, you had non-deposit-taking institutions command more than 50% of the gross loans wallet. And for the first time in 2024, we saw the deposit-taking MFIs dropping to about 47% of the market share. So the 6.7 billion that we're seeing for the deposit-taking institutions has been overtaken. They've been overtaken by the non-deposit-taking institutions. If we look at metrics like revenue, revenue was up 5% year on year to about 930 million. But what is interesting is that even though revenue has gone up, we've seen a 3% reduction in profitability by 3% to somewhere around 280 million across the industry. And the main driver of that is escalating costs. And you note that most of these MFIs are traditional in terms of brick and mortar. So those are some of the things that we're seeing across the industry.
Wow, that's quite fascinating. We've also had a chance to look at the report, and thank you so much for sharing it. Your report actually shows that 6 out of 7 MFIs achieved year-on-year growth, but one faced a 13% profit drop. What's driving this divergence, and what does it signal about the sector's resilience?
Thanks, Mwelwa. So what you notice is, if you look at the players in this sector, like you rightly said, only one has seen that drop. And maybe what's even more comforting is that one MFI that has seen that drop is the market leader. So the industry still remains resilient.
Okay.
And that market leader has been commanding over 50% market share for a very long time. At some point, it was in about 60%. Last year, it was 50%. This year, for the first time, they are below 50% to 44%. So the industry is still resilient. I think it would be more worrying if we saw that drop on the bottom players.
Right.
But
so it's more of an outlier.
Precisely,
Okay.
it's more of an outlier. And if you look at their numbers, it looks more of competitive pressure. Because when you look at revenue is up. But what you then see is how do we then, can we calibrate our costs at a fast pace to catch up with the competition? And you find that maybe if you're predominantly brick and mortar, the pace at which you can adjust your efficiency is not as your peer who's more into a hybrid model or a digital model. So we are seeing pressure, I think competitive pressure, because even if you look at their loans and advances, the rate at which they're growing, they grew about 2% year on year. Competition, average on the industry is growing about 5-8% somewhere there, so they're growing below the industry. And maybe one of the things that because they've got so much large scale, so their growth may not be relative to a peer who's doing probably 10% of what they're doing. But we are seeing it more as competitive pressure, which is also compressing their margins for them to remain competitive.
Right, and in addition to that, one of the things obviously we noticed that was a major MFI's revenue share dropped from 50%, as you indicated in the first time we discussed this report, to 44% between 2024 to 2025. Is this a healthy competition or a warning sign for market leaders?
So if you look at, like I mentioned, so you notice that this is the first time that the top MFI is having wallet share that is below 50%. Now, wallet share is relative to the peers, right? So we'll then go and say, is this MFI growing? Or maybe is it that it's growing, but the peers are growing at a faster pace than they are growing? So when we interrogate that, you will find that they are seeing a reduction. So revenue was down quarter on quarter. If you look at loans and advances only expanded by about 2%. So what you notice is that the industry is still healthy, but there's a lot of competition. And one of the reasons I'll say that is if you look at the demand that is driving this credit, we have about 1 point from the last census, we've got about 1.2 million formal workers in Zambia. 32% of that is civil servants, government workers. And you also notice that if you look at, for example, on the Bank of Zambia data, you find that over 60% to 70% of the credit happens in Lusaka and Copperbelt. So you have concentration in terms of region, you have concentration in terms of product. So you find that what is driving your demand are the same things. So you're all competing for the same base, and you're all probably competing using the same techniques, using the same methodologies. But then we also see other new players coming in, the digital lenders and things like that. Especially those that are non-deposit taking, they employ hybrid models. So we are seeing their market share reduce, and we're seeing the likes of the second and third players taking up that opportunity.
Right.
Exactly.
Now, one of the other things that we observed was that one leading MFI's deposit to loan ratio jumped to 103% from 83%. Is this excess liquidity a strategic advantage or missed lending opportunity?
So if we look at the trend, so if we go back to the previous ratios, that was 83%. Before that 83%, I think we had somewhere around 75%. So it looks like it's more of a deliberate, strategic play. And the reason we say that is when you see what you want to do is you also want to match the quality of loans that you give out.
Correct.
So sometimes you want to build up a buffer so that you can then deploy credit in a more efficient and quality credit. So if that ratio remains the same for a long time, then I think we can call it a missed lending opportunity. But if you're coming from 83 to 103, then probably in the next edition we'll see that ratio go down. It will show that it's most likely a strategic move to can we increase our low-cost funding base and then deploy capital. Because if you look at that same MFI, their net interest margin is one of their lowest. And because they're coming from a place where they had to use shareholder funds to deploy. But it looks like it's a strategic play to how can we build up this and possibly increase our net interest margin and deploy into quality assets.
Right. And before I get into issues of ROI, maybe if you can actually share, because I know you and your team also coining. We're not calling it the Champions League. I don't know. Maybe we could call it the Europa League. But are you able to just share with us who the top 5 players were?
So the top 5 that we have, of course, you have your Bayport as your leader, 44% market share. You have Microfinance Zambia with about 22% market share. And then you have LOLC, Lock Finance. And then, so when you look at the way the MFI sector is shaped, you don't have a league, for example, that has 3 players. So each MFI is in its own league.
Right.
So you have your Bayport in its own league, commanding dominant position. You've got Microfinance Zambia, then you've got Lock, then you have your EFC, you have your Vision Fund. So they are all in their own unique categories. But I think in the next 2 to 3 years, we'll probably see a second tier where we'll have Microfinance Zambia and Lock, because if you look at the growth that Lock has had, 49% year-on-year growth in terms of profit after tax, and they've been posting that consistently. So we expect to see a league, a second tier, where you have Microfinance Zambia and Lock in there.
It does feel a bit like the FIFA Club World Cup, where you're getting players from different leagues.
Precisely.
Now, turning your attention to return on equity, with one MFI hitting 40% return on equity, what operational strategies are separating top performers from the rest of the pack?
So if you look at the industry, Mwelwa, return on equity on average for the industry is around 20 to 22%, which is quite decent. But if you look at the outliers, and that MFI that has done up 20% return on equity is an outlier. But what has driven that is aggressive growth in terms of revenue, as well as managing their costs efficiently. So they've got a very good cost to income ratio, I think about 43%. So it's 2 things. So the rate at which the revenue has grown over the last 3 years in comparison to the rate. So they've managed their cost base very well. And they've also deployed assets in pockets where they've been able to maximize their revenue. And that's why they're posting such return on equity. But if you look at the entire industry, it's about 20 to 22%.
Right. Now, you previously mentioned digital lenders entering aggressively. How are traditional MFIs responding to this threat, and Who's winning the digital race?
That's an interesting question, Mwelwa, because the first part is like, how do we define digital lending? Because when you look at the credit process has onboarding, it has evaluation, it has disbursement. But what we normally see is that most of the MFIs that are calling themselves digital, you find that it's probably the onboarding that is digital, but the rest of the processes are manual, right? But to answer your question, what we are seeing is a space where we have traditional MFIs, and most of these would be your deposit taking and a few non-deposit taking. So one of the ways they're responding to this threat is they're also moving into hybrid models. So they are moving some of their products, some of their processes into the digital space.
So it's like they're adapting.
They're adapting. But also, one thing that we see is that the playing ground may not be as fair, because on one hand, you've got these MFIs that are regulated by Bank of Zambia.
Correct.
And then most of these digital lenders are not regulated by Bank of Zambia. These are digital lenders who just get a license called money lender's license. So no one knows how much they've disbursed. No one knows who their shareholders are. No one knows what products they are offering. No one knows their gross loan balances. And some of these are actually bigger than those that are regulated by central bank. So you find some of these digital lenders are even using predatory lending techniques, unethical lending techniques. But if an MFI that is regulated by a central bank did that, they would be penalized.
Absolutely.
So what that calls for is also, can we have every money lender or anyone offering credit, anyone extending credit has to be regulated by the central bank.
Correct.
To bring sanity so that everyone can compete on the same field. Because right now we have MFIs that just go on digital platforms. They have light KYC. They just ask for your NRC number. They haven't even seen it, right? And those are the ones that will now be harassing customers and things like that. So we need some form of regulation because if we don't do that, we'll find that we don't even know how much loans have been disbursed by this.
Correct.
So we might be talking of 6 billion, we might be talking of 44 billion, and yet the money lenders probably even do twice that amount.
That's true.
So we need some sanity in that space, I think, for us to even just compete competitively on the same level. And it's been done in other countries, Kenya, Zimbabwe. Exactly.
Interesting. Now, for investors drawn by the sector's 22% average return on equity, which specific opportunities in Q2 offer the best risk-adjusted returns?
Thanks, Mwelwa. So if we look at risk-adjusted returns, I think three things come to mind. So number one is which institutions are driving aggressive growth. And of course, when we look at aggressive growth, we also then need to understand what is driving this aggressive growth, right? The other thing is which institutions are efficient, right? And in efficiency, we'll talk about operational self-sufficiency, operational cost ratio, cost to income ratio. But behind those ratios is a deployment. How are you deploying capital?
Correct.
So you find that most traditional MFIs, for example, are brick and mortar. They have a high cost to income ratio. Yeah, so if you're looking for risk-adjusted returns, those are some of the things that you look at. Which institution will offer, in the long run, efficiency, and that efficiency comes from digitization of the processes, both internal, external, in terms of onboarding and things like that. But also importantly, I think, like I mentioned earlier, is we are seeing over concentration in the MFI space. So you find that most of the MFIs focus on civil servant loans. And civil servants, most of them, you find there's a lot of credit stacking, over indebtedness, and not just on the civil servant, but let me just say the formal sector that they're tapping. But there are also opportunities in the SME space, and these are some of the things that we've been doing in the background. The risk is there, but the return is also there. So it's a classical example of risk return. Just manage, mitigate the risk, you get the return.
Right. Yeah. Now, based on Q2 trends, and I'm sure you and your team have obviously sat down and you have a bit of a plan here into the future. Yeah. Are you just able to share with us, what you're seeing as possible predictions coming, and especially around sector dynamics by year end, and which MFIs might challenge the current top two dominance?
So if we look at the gaps that are there amongst the players, we don't see anything changing at the end of the year. We still expect to see Bayport commanding. We still expect Microfinance Zambia to be number 2. We still expect LOC to be number 3. So we don't see. We expect the wallet shares to change. But we don't expect the ranking to change. But we definitely, because what we've noticed, for example, is that quarter on quarter, Microfinance Zambia has been getting about the 100 basis points or 200 basis points increase in their share. Right. So we expect to see that momentum across MFZ, LOC, EFC, and the other players. But we don't expect to see a change in the ranking, not just yet. Maybe in the next 2 to 3 years, we might see a change in the ranking.
Right. Yeah. Interesting. In our final question, you promised to expand into customer service to capture ground level sentiment. What early insights are you gathering from actual MFI customers, and how do their experiences contrast with the strong financial performances we're seeing in the data?
Thanks, man. So we are in the preliminary stages of the surveys, and some of the things that we are seeing is on the demand side of credit, right? So, for example, when we look at what behavior drives consumers to go and borrow. So insights we're getting, for example, would be consumers don't look at price, especially consumers for MFIs. If you look at banking sector, corporates, they're price sensitive. But if you look at the consumers on the MFI space, price is not a big factor for most of them. The biggest issue from the preliminary findings is that it's turnaround time. How quickly can you give me money? We'll talk about the price later. We'll talk about the terms later. But how quickly can you give us the money? And that's where things like digital come in handy. AI scoring models come in handy. So that on one hand you're reducing, because you also don't just want to lend out, you want to make sure that the quality of the credit is top notch. So you bring in, for example, AI scoring models to help you mitigate that risk, but at the same time you can quickly review a credit and disburse money, knowing that you've done your evaluation properly.
Right. Yeah. Chiti, it's always a pleasure, catching up, with you. We know that, from here, we should be getting the bankers report once Q3 is done. So to our viewers, please do stay tuned for this particular report. We anticipate that the light at the end of the tunnel for 2025 performance, if we can call it that, will be very, very clear. So I think maybe just a final word for people that are keen on accessing the report, how much it costs, Where can they get it? Please do share with our viewers.
Thanks, Mark. So for the banking report, you can reach us on our website. That is www.finwiseltd.com. And we have a drop down, all the information is there, banking details and everything. And that also applies for the microfinance report. So for the microfinance report, it's going for 7,500 kwacha. And that can be used across the organization. And what we've seen is that most of these organizations are actually using it in their strategy meetings, in their monthly management meetings, as part of how do we position ourselves relative to competition, because that's important. And we've also had other MFIs, because we have this data that goes way back. So we've got other MFIs reaching out to us, can you customize this report? Correct. We want to see this, we want to do that. And because that's our core, is to get the insights. So we've done that for them. The banking report is going for 20,000 kwacha only, and it can also be accessed by the entire bank, sent to staff, and the response has been very overwhelming, both from MFIs, commercial banks as well. And interestingly, I think most of it's employees of the banks. Correct. They really want to see how are they perform, and that's a good thing, because they want to see what their input is translating into, which is a good thing. Then it helps shape behavior as well.
Absolutely. Chiti, thank you so much for coming to the show.
Thanks so much, man. It's a pleasure.
Absolutely. So you've heard it for yourself. We've been sitting down with the team principal at Finwise. I've been Mwelwa Chibesakunda for Financial Insight. And as we always say at Financial Insight, get to know.